Well, hey there, everyone. Happy Thursday, April 9th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, hanging in there, under the weather still, but hey, good enough to do the show. Thanks for joining me here. Those of you doing so on the live stream. If you're watching our replay on the YouTube channel, so glad you joined as well. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. You are more than welcome to ask questions all along the way. Just use the comments section in any of those live streaming platforms, and we'll see it here on our side. If you're watching the replay, just use the comments section on our YouTube channel. You can ask questions there. And we are planning an all mailbag episode on Friday, and we'd love to answer one of your questions on the show. Those mailbag episodes are a lot of fun to do. Gives me a chance to take a deep breath and really reflect on some of the more thoughtful questions, ones that I want to take a little more time answering. And please, nothing's out of bounds. And I've already gotten some great questions lined up for tomorrow, but we can always use one more. So thanks for considering that. Decent day today, right? The S&P 500, the Nasdaq had a bit of a weaker open, but a nice acceleration going into the lunchtime hour. Afternoon was kind of holding steady, but enough for the S&P to be up about 0.2%, a little better for the Nasdaq. The VIX closing back below 20. Breadth conditions accelerating to the upside. The S&P pushing back above 6,800. At some point, we have to acknowledge that this is quite a bit of strength off of those lows. And I think, again, we're seeing a relief rally that tells you how much of the pressure on this market has been driven by, concerns about events in the Middle East. What's interesting is we've seen this kind of V-shaped recovery. The way down was caused by the initiation of hostilities in the Middle East. The recovery has been driven by the expectation that there's a wind down, the ceasefire in events in the Middle East. Here's the thing, though, right? Once the whole Middle East thing is done, we're kind of right back where we started. And the concern I have is in January and February, we weren't making new highs, right? We'd sort of stagnated. So I don't necessarily see what we've observed in March and April to be a super bullish development. It's more like a very bearish development became not bearish anymore, but we're right back where we were. So I think we're in the same issue, arguably with more inflationary pressures and uncertainty than when we had before, when the S&P wasn't able to break above 7,000. So is this, is this conflict in the Middle East that kind of erupted and now is being wind down? Is that enough to cause the S&P to go significantly higher? I wouldn't think so. Strong earnings would convince me that the S&P is going to go meaningfully higher. We're going to start that next week. We've had a sprinkling. We've had like 20 S&P names. I think about 5% of the S&P 4% have reported so far. It's not been going too poorly, but next week is when things really start to heat up. So we'll be here along the way to navigate these markets with you. As it is, let's look at what happened today. We mentioned the weaker open, stronger midday, sort of sideways close. So right from noon to 4 p.m. Eastern, the S&P kind of held its ground right around 68.25. The big move today was from around 10:30 a.m. to noon. That was an acceleration to the upside, sort of setting up a new peak. A lot of the charts that we talked about that had that initial breakout higher, a lot of them kind of moving even further. Charts like Teradyne, the SMH, which I kept on the list today so we can review it. Holding in there pretty well, and honestly, even going up a little bit further. So we're seeing more improvement. We're seeing continued upside, and I think that's something we have to acknowledge. So today, S&P closing just below 68.25. That's up 0.6%. The NASDAQ composite up 0.8%. Mid caps and small caps all in the green, which is all pretty positive. The VIX closing back below 20. It's been above 20 for a little while here. And I think for me, that has been the biggest area of concern for this market, among others, has been elevated volatility, because it's just sustained bull market recoveries don't happen with the VIX above 20. Occasionally, but it's super, super rare. What's much more likely is we need the VIX back below 20. So I think the fact that that happened today is pretty encouraging. We break back above 20. I think that tells you, anxiety rising again. But for now, back to a low volatility environment, which is encouraging. Rates ended up chopping around, but not really moving a whole lot today. You can see that the 10-year and 30-year points pretty much where they started, but it was quite a move, right? So we have the 10-year yield go up, go down, and then end up right back in the middle of the range where we closed yesterday. So 4.3% remains the level on the 10-year. 30-year point is at 4.9% today. Dollar index down slightly, which has been the trend so far in April. DBC, which is a commodity ETF, up about 0.5%. Gold and silver, some of the stronger areas of that group of commodity ETFs. The GLD up 0.8%, silver up 1.4%. Crude oil prices actually ended up a little bit higher here, about 2% higher. So that's a little different than the dynamics we've observed recently as we've sort of considered a wind down of hostilities in the Middle East. Crude oil prices have been coming down. Energy stocks have been coming down. Energy stocks still were the worst sector today, but crude oil prices in the form of the USO actually moving higher. So it looks like still, and the headlines have still been the Strait of Hormuz is not quote unquote open for business. I would say that's a big time air quotes around that one. So we'll see, and whether crude oil prices remain elevated here. Cryptocurrencies feeling some strength here as well. They accelerated higher going into the equity session. Bitcoin is currently in a nice upward trajectory on the tactical time frame. Currently above 72,600. That's up over 2% today. Ether prices over 2,200. All 10 of the top coins here in the green. Bitcoin above 75,000. Again, it's like with charts like that we've been talking about, a lot of these have been in pullback mode. They've been in frustrating, choppy sort of risk off moves, but we always have to define what's that level where we decide to re-engage. And for me, 75K on Bitcoin is the level I'm watching for. It's getting closer here as we have further acceleration higher in risk assets as the week progresses here. Sector-wise, offense over defense is a general way I would describe what I'm observing today, although that's not completely true, but certainly at the top of the list because you have the XLY up 1.7%, consumer staples up 0.8%. So that ratio of offense to defense continuing to favor offense here. And we saw the equal weighted version breakout earlier this week. We're seeing more of that as the week continues. Industrials also up about 1%. 4 and 5, though, you get to defensive sectors like utilities and real estate. Technology, communication services, kind of middle of the road, and both of them underperform the S&P today, which I think is a noticeable, condition to this rally. What's interesting is breadth indicators are improving dramatically, as we've been sharing with you. A lot of other areas of the market, right? Particularly like financials, which were not an outperformer today, but financials are doing pretty well in April overall, particularly relative to how they were doing earlier in 2026. But technology really not a part of the recovery in terms of the overall sector. There are areas of the market, particularly semiconductors, doing quite well. And Amazon today mentioned AI in a note to investors, and the stock's up over 5%. So AI is still getting people pretty optimistic here when used appropriately, but the XLK as a sector not particularly strong. 3 of the S&P sectors were down today. Energy continuing to lag in April, down 1.25%. Materials and healthcare both slightly lower from yesterday's close. I mentioned the breadth conditions continue to look pretty good, and on the NYSE, you've got 62% advancers versus 36% decliners today. On the S&P large cap index, not quite as positive, but pretty close, 58% up to 42% down. Small cap space had the best breadth with 71% advancers versus 28% decliners. So what happens with indicators like breadth, I always think of them, you have short-term breadth indicators and long-term breadth indicators. Short-term breadth indicators would be things like the trend or the ARM index created by the late Dick Arms, which is really a day-to-day kind of breadth reading, really looking at short-term trajectories. The McClellan oscillator, also a short-term gauge. The McClellan oscillator was negative all through March, flipped positive at the beginning of April. But the long-term measures of breadth were not positive yet. Now what we're seeing is the short-term breadth has been consistently strong. All of a sudden, the long-term breadth numbers starting to improve. So more and more stocks in the S&P regaining their 200-day moving average. I think that's pretty encouraging. And we'll share with you that chart here in a bit. Our market trend model, we're keeping an eye on it. It does not look likely, barring some ridiculously strong Friday. It seems like our medium-term model on the S&P 500 will remain bearish. So that, for me, is the main kind of risk gauge as to whether I want to be risk on or not. V bottoms are always a challenge when you're looking at trend following, because the trends are very negative and then the trends turn very quickly, and it takes a little while for a model to react. So for now, my model is still going to be risk off, it looks like, as of Friday's close. We'll see what happens on Friday's session, but looking at the math, it's pretty unlikely that that would happen. Although you may notice on mid caps and small caps, it looks like that most likely does turn higher. Looking at the Magnificent Seven and Friends, these leading growth names, I mentioned Amazon. I saw the headline about the Amazon executive writing about AI investment and upside potential. And so the market rewarding Amazon being up another 5.6%. That's your best performer in this group. Netflix continuing to impress, pushing above $100 a share with a nice follow through above that level, up another 2.7% today. Meta up 2.6% as well. Microsoft, the worst performer of this group, down about 1/3%. That is one that has not really performed relatively well. Tesla has by far, I think, been the worst chart of this basket, up 0.7%, but not enough to change that chart from anything but negative at this particular moment, I would say. So overall, kind of a risk-on move, I would say, with stocks. They opened lower, but the surge higher midday really, sort of signaled a continuation of the trend at the single stock level. I think we'll find a lot of pretty interesting charts to reflect on here in a moment. I do see some comments coming in on the different live streaming platforms for us. We're on Facebook, LinkedIn, YouTube, and X right now. Thank you guys. If you're tuning in live, please drop a question on any of those platforms as you're watching. We'll grab a question or two as we go. Any of the questions we don't get to, we will put in the mailbag. We're planning an all mailbag episode on Friday. That's tomorrow. And we'd love to answer one of your questions on the show. So if you're watching the replay, please use the comment section on our YouTube channel. Would love to hear from you for sure. All right, looking at the heat map. Heat map doesn't look quite as good as I thought it would, given what happened with the benchmarks today. It sort of looked like, and the breadth was pretty strong, but I'm seeing a lot of red on here. So it certainly seems to me like there were a lot of stocks that did not participate in the uptrend to the degree that you might have expected earlier on. I guess I'm kind of surprised after doing that first part of the show, looking at all the major benchmarks. When I was looking at the market carpet earlier in the afternoon, I was like, oh, like not as good as I would have expected. And let's make sure we're looking at the right setups, which we are. Performance, yeah, this is all good. Yeah, when you question the data, I always refresh it. I mean, it looks pretty good here, which tells me that even though the benchmarks were up, I mean, look at all the down moves in technology. I would say that's a huge, that's a fascinating one, right? The IGV, someone mentioned on the show, the chart of IGV, the software ETF. I kept that one on the list so we could just see that it's down again today. And I mean, look at all these names that are down significantly, right? ServiceNow. Now these are some of the worst charts in technology, to be totally clear, right? So there's a big difference between, I mean, look at Applied Materials and look at ServiceNow. These are in the same sector, but it's almost like you flip the one chart over and you get the other. So this is one of those times where, as much as we love to think of technology as a thing, and they're kind of all doing their thing together, more and more as the year 2026 has gone on, and something like ServiceNow has been in a downtrend for a year now. So it's not just a new thing. But I think, especially on a day like today, I think it's remarkable how much some of these names are down, like a Palantir down another 7.3%, really close to making a new 3-month low. And then you have some of these charts just in these primary downtrends, right? Salesforce, Adobe, these are all the software names just in consistent downward trends. So this is one of those times. So we're owning the XLK, probably not the best option. Owning a technology ETF just because it says technology in the title, probably not a good idea. Owning ETFs that have exposure to the charts that are looking very strong, that's where I think, excuse me, we have the right idea, right? One of the benefits you have as an equity investor, and if you use ETFs, is that you can, really focus on exposure to areas of the market showing strength. And I think that's one of the biggest mistakes that a lot of investors make when they don't have enough of a technical input into their process. You diversify just to diversify, and owning a bunch of technology names that are going down doesn't seem like a great idea to me, right? I mean, forget diversity. I mean, I'm diversification. I don't want to diversify into bad charts just to feel good about diversification. Let's make our bets on charts that look good. This is why I finished the show with, it's always a good time to own good charts, and why my own portfolios are run with momentum strategies because I want to keep avoiding charts like ServiceNow or CrowdStrike that look bad. And I want to continue to own things like semiconductors that look good. And when they stop looking good, the chart's going to tell you, and then you rotate. And so, again, hopefully this show is part of that process for all of you. Just kind of recognize what's happening. So the AI trade appears to be alive and well. All the chip makers, the semiconductor names, a lot of these making new highs or very, very close to doing so. Stocks like AMD bouncing off of support at 200. So I continue to see that as a fairly strong areas of this market. Even GLW Corning making a new all-time high today. So again, I would say one of the big takeaway, my initial takeaway looking at the heat map is the weakness in a lot of areas of technology, despite that the fact that the market was had a pretty decent day today. Financial is very much a mixed bag as well. It looks like the big banks generally did pretty well. So if you look at like JP Morgan, BAC, MS, WFC, these are all stocks that had gone down February into mid-March. And since mid-March, over the last 4 weeks, have had a pretty impressive recovery and have regained moving averages and are now starting to push higher to a degree that you start to be believers, I would say. Having said that, there are areas of the financial sector that did not do particularly well today. A lot of these are in a group like S&P Global, SPGI. These are in a group called like specialty finance, I think is the Dow group that's used on stock charts. Like the exchanges like Intercontinental Exchange, ICE, the CME. That area of the financial sector was all down pretty good today. Invesco also not really participating. FactSet has been in a downtrend for quite some time. So it's sort of like certain areas. And Visa and MasterCard didn't really do much. Those have been struggling so far in 2026. So there's a real, I feel like, again, there are very few sectors where it feels like it's just one move. This feels like one of those times where stock picking matters and really, just again, owning the XLF because it's the financial sector. I'd rather own the banks that have much better charts than, like things that I mentioned, like insurance or specialty finance, which have not looked as particularly strong. Healthcare having a particularly underwhelming day, I would say, with a lot of red there, and honestly, with how good of a day it was, again, don't write off consumer staples just because they're traditionally thought of as a defensive sector. I think the chart of Walmart looks pretty good. I think it'll look concerning here in mid-March as we're undercutting the 50-day moving average. But if you look, basically like 120, 122 has ended up holding, and we've had a couple moves right down to that level, but we've bounced higher, and now we're seeing Walmart with this fantastic bullish engulfing pattern with Tuesday's down day, Wednesday's lower open, higher close. Nice follow through today, getting back over the 50-day moving average. So I say charts like Walmart, big thumbs up in terms of strong charts, kind of recovering and getting stronger. In the energy sector, obviously an underwhelming day as we've, as events in the Middle East kind of evolving, this implication that the Strait of Hormuz might reopen. And again, just the headlines are hard. It's hard to really get a sense of what's going on here, to be honest with you, because I'm seeing a lot of conflicting headlines depending on what this is one of those painful times, which I feel like happens too much, where depending on what media outlet you're consuming, you probably have a very different picture of what's going on. And it's hard to know what to believe in terms of the potential impact. But from everything, I try to observe, I try to consume from a lot of different sources, different political leanings, just to try to get a sense of where the reality might be and how things are being portrayed. And I mean, my sense, and I mean, tell me if you hear differently, but my sense is that, a ceasefire is sort of tentative and questionable. And what actually happens with the Strait of Hormuz, it's not reopened. It's sort of somewhere in the middle. It's this gray unknown area. And so, for now, energy prices coming off. For now, charts like ExxonMobil and Chevron and COP and these others are pulling back here in the month of April. I kept one of those. I think it was COP or CVX, whichever one. Still okay, right? Still holding the 50-day moving average, but certainly feeling the short term pain there. I have a lot of charts to get to, so I don't want to spend any more time on the heat map. The only thing I would just say is there are a lot of stocks starting to break out. There are a growing number of new 52-week highs, including Caterpillar making a new 52-week high. So keep an eye on some of those industrial stocks that have been pulling back, chopping around at the end of Q1, having a pretty strong April and rotating higher as this month progresses. We're going to get to a bunch of charts that I've hand selected here in a moment. Before we do so, do want to thank one of our partners, Seeking Alpha. If you go to marketmisbehavior.com/seeking alpha, you'll get 10% off of a new premium account. I use Seeking Alpha for a number of different things. Number one, I love their portfolio health check. It's like taking your portfolio to a wellness check at the doctor, kind of that annual physical that you don't do, but you know deep down that you probably should. You can do that with your portfolio. Take it to the doctor, have it run its quantitative model, highlight areas of your portfolio you may want to revisit. I don't use that as a hard and fast buy or sell rule, but I use it as a sense of where I might want to dig a little bit deeper. You also have some great scanning capabilities with their proprietary quant model, which I've reviewed in great detail, have discussed with their the head of the quant team, Steve Kress, and I'm a fan. You can find more information at marketmisbehavior.com/seeking alpha. Again, use my link. You get a little better deal. You get 10% off on a new account, and helps me make Market Misbehavior awesome. So thanks for checking it out, guys. All right, let's finish off with a bunch of charts that I've selected. I had to actually, sometimes I have a couple charts and then I try to find some other interesting ones. This is one of those times when I have a ton of great charts. And so I had to just stop. I was like, all right, I'm going to stop grabbing charts and just, I need to go with what I have because there's just a lot of things that have started to shift here this week that I want to make you aware of. So first off, the S&P closing above 6,800. Yesterday on the show, we talked about how we traded up to 6,800, but did not get any further. Here I am proud to say the S&P followed through just fine above that breakdown level. What that means is I'm out of resistance levels, right? When we broke down, we had this initial rotation lower. We talked about breaking the support at 6,800. That was our line in the sand in blue. We broke it. And I said, all right, we're now in a downtrend. We need to keep thinking about downside targets. And we hit them and kept going. And we eventually broke below 65.50. After that point, after getting down to around 63.20 or so, we have now rounded back up. And then earlier this week, the big gap higher as the ceasefire was announced, late Tuesday evening for us here in the Pacific time zone. And then yesterday's session, we closed back above the 50-day moving average for the first time since the end of February. And then today, with the nice follow through, closing above 6,800. Again, so again, holding that level of 6,800, I think is pretty important at this point. We're out of resistance, right? So I think 6,800 becomes the new support. We want to make sure that that's held. The other thing that I would note is that the RSI is pushing above 60 this week, and I think that's one of the more other bullish pieces of evidence to think about. Again, I can come up with all the reasons why the market should not go higher. And again, when we have something like we've observed in March and April, when we had the big sell-off and now the big recovery rally, when you think about what caused those moves, right? And I would say that is directly tied to events in the Middle East and the economic implications, right? We're back where we were at the beginning in Q1, right? January and February, where the market's stagnant, right? The market's kind of stalled out at 6,800 to 7,000 and then kind of sideways. So we were already skeptical about further upside. So I don't feel super optimistic about further upside here. Given some of those macro conditions that are still there. However, I have to acknowledge that the momentum has been quite strong off the lows. I have to acknowledge that the breadth indicators have improved, and we're back above 6,800. It's a nice breakout above key resistance. I also want to point out a Fibonacci analysis, right? Just looking at the S&P 500, taking the high, and that's at the end of January, right into February. Then we go to the low at the end of March, around 6,300 and change. 38.2% is up here around 65.80. 61.8% is around 67.40. If you look at the gap higher, we gap just above that Fibonacci level, and now we're continuing higher. So that's one of those now we're going to have a confluence of support kind of in the 67.50 range, and 6,800 was the swing low from before. We're kind of right there, just getting above that level. So I think as long as this holds, that's pretty good. The problem, again, the issue I have, this has all been headline driven. So I think we're one bad headline away from the market going lower. But for now, most bullish thing the market can do is go up. That was a legendary technical analyst, Paul Montgomery. I'll never forget reading that in his newsletter. Thought that was awesome. That was probably in like the Ooh, like 2012, 2013 range or something like that, when we're debating whether the S&P is going to make another new all-time high. And I remember reading that and thinking, wow, that's brilliant. Here's what's happened in the month of April, by the way. It's been kind of an everything rally, right? Bonds are maybe the only thing that really hasn't gone up a ton. It's really been sideways if you look at the TLT, but gold up, equal weighted S&P up, cap weighted S&P, Nasdaq, Magnificent Seven, Bitcoin since the end of March and late March to where we're at now. All of these things, really, except for the bond markets, which technically are slightly higher, just not by much. Everything's been kind of pushing higher here. So that shows you sort of the strength of the downtrend and the strength of the reversal. And again, until proven otherwise, certainly feels like quite a bit of optimism being injected into these markets. I'm seeing high yield spreads start to come in quite a bit in the last couple of weeks. This is a high yield option adjusted spread. I haven't shown this in a little while, so if you're not familiar with this, high yield spreads are basically the credit spreads for junk bonds or high yield bonds, bonds of risky companies. Option adjusted spread, don't worry about that. That's just a fancy name, a way of saying you're kind of looking at all the bonds on an apples to apples basis. You're exercising all the options. And so an option adjusted spread kind of makes an apples to apples comparison. What's the average spread for junk bonds? They've been widening out in February, which was an area cause for concern, widening out again through much of March, but now really starting to narrow up. And that's encouraging. That means bond investors are seeing less risks out there. Volatility, as we've mentioned, has come in. So not surprising that equities and other risk assets are rallying pretty well. Now, on this rally, the question has been, will breadth improve? And short-term breadth indicators like the McClellan oscillator turned positive at the beginning of April. The percent of stocks above their 50-day broke above 30% beginning of April. That's all bullish. Percent of stocks above their 200-day moving average had not quite broken out until this week. Last couple of days, we're seeing that indicator push up to around 57%. So now we're seeing most S&P stocks regaining their 200-day moving average. That's a pretty bullish, confirmation. So as long as it holds 50%, it's still bullish. So for now, pretty constructive. The advanced decline lines are all rotating higher, and that's really what the McClellan oscillator is telling you. It's telling you the slope of these lines. They're all going up. All four of these now have regained their 50-day moving average. None of them have broken to a new 52-week high yet. We have to get above those February peaks for me to consider these bullish green again, but something to watch. There's the McClellan oscillator going pretty positive for now. One of the things we mentioned was there hasn't been a lot of new 52-week highs, but so far in the last couple of days, we're actually just starting to see it. We talked about charts like Teradyne, right, in that coil pattern breaking out to the upside. There's a number of charts that are actually starting to do that, a growing number of charts. I mentioned like Caterpillar making new 52-week highs. So we hadn't had a lot of early leadership names breaking out. And in a bullish break, right, the S&P does have a chance of getting above 7,000. You need a bunch of names before the S&P, kind of those early leadership names starting to break out. And we've seen that on Wednesday's session, then again on Thursday's session. Today, we've got, 9% of the S&P 500 members made a new 52-week high today. That's not nothing. So overall, pretty encouraging. Another encouraging sign, VIX back below 20, right? So that's good news. VIX has been above 20 since the end of February. This continued uptrend in the VIX has been one of the most, I think, important signals that we observed at the beginning and through the first 2 months of the year, suggesting to us that even though the S&P was sideways, the volatility was steadily increasing. We were starting to get above 20. At the beginning of March, we really exploded above that 20 level, which told us big time risk off. Back below 20 means we're in a low volatility environment. It's happened. Today, the VIX closed below 20. We finished the week below 20. That's a pretty bullish sign as well. Sentiment data, just to, get you caught up. Weekly survey data we review for the AAII survey, which is an individual investor survey. Then we do the name exposure index, which is a survey of wealth managers, money managers. First, the AAII survey continued to lean a little bit more bullish. We're up to 36% bulls. We're down to around 43% bears. We almost got to 60% bearish, which has often been a really contrarian, important contrarian level. We didn't get there. We got to around 55%, and that was it. So bears coming in quite a bit, bulls increasing, the spread between the two coming in quite a bit. So individual investors in that survey over the last week getting a little less bearish, a little more bullish. The name exposure index, though, not changing a ton. So consider this survey, I would say, skeptical, still underweight at 69%, below the average for that indicator. Something to watch for sure. Semiconductor ETF, we gapped higher yesterday. We continued higher today. The SMH made a new all-time closing high today. New highs are bullish. So the SMH breaking out after a gap yesterday. RSI pushing above 60. That's pretty bullish. Amazon, we mentioned yesterday, getting up to the 200-day moving average after that gap, but closing more toward the lows. All better. Today, we've got news of Amazon leadership talking about justifying their investment in AI, success with their AI part of their business, and the stock being rewarded with a close above the 200-day moving average for the first time since early February. The momentum there improving as well. Netflix back to overbought, but I see that as a good thing here. Getting back above $100 a share, finally closing above that threshold on stronger momentum. IGV we mentioned yesterday because the markets were rallying, but software stocks were not. Even worse today, the IGV down yet again. So certain areas of technology not a part of the success story. You can see the IGV, and if you look at the holdings of the IGV, I usually do that on Koifin. Excuse me. But if you look at the big names in there, it's some of those charts that we reviewed earlier that were in primary downtrends. By the way, if you follow stock charts, the stock charts technical ranking or the scooter ranking, IGV is in the first percentile out of 99. It's a number 1. That means it's literally one of the worst ETFs out of the entire ETF universe that is part of their ranking system. That tells you how bad that chart is. It's really bad. Chevron's still not a bad chart. And I just have to point out, even though the stock has pulled back since the end of March, even though we are testing the 50-day moving average, we're still holding the 50-day as of today's close. We're still holding that, 38.2% level. I think that's pretty encouraging. RSI still holding 40. I wouldn't be that scared of that chart just yet. We break a little bit lower, though, and it would be less than ideal. Delta Airlines, one of the first S&P companies reporting earnings this week. It did not go particularly well. We gapped higher at yesterday's open, but closed down at the lows of the day. Today, drifting a little bit lower as well. Boy, I need to wind down because my voice is dying here, but I'd love to take a question or so. Steven, thanks for watching on YouTube. You mentioned CPI tomorrow. And again, my goal is to inform you and help you understand what's happening on the charts. And I think I've pointed out this has been a broad advance this week. The S&P is getting above key levels that we considered important resistance. And I think that's important to watch. Again, we're one bad headline away from the market giving back some of these gains. CPI tomorrow could very much be a game changer. There's been quite a lot of speculation and expectation in some camps that inflation is much bigger of a deal than we've been led to believe or that we've seen in terms of the hard data. The CPI starts to reflect, some of the events that have happened here in the last 6 weeks. We'll see where the CPI comes in. The CPI comes in way higher than expected. Expect the markets to go risk off in a big way. And if that's how we finish the week, oh, that'd be rough, wouldn't it? Right angle triangle. Thanks for watching. He said Microsoft acts relatively well compared to IGV Software Group today. Maybe bottom is close. That's a big emphasis on maybe there. We'll look at the chart of Microsoft. I mean, so the argument for Microsoft is that it's so bad it's good, right? It's so far down. We're testing this key support low, right? We're basically testing the low from the tariff tantrum back here at the beginning of Q2 of last year. So a year later, we've round trip back to those lows. For me, buying when something's at a major low is usually not enough. I like to buy a recovery. I like to buy accumulation. I think seeing some signs of accumulation, seeing improved volume, seeing improved momentum, seeing indicators like the weekly PPO starting to turn higher, those would be the things that would make me interested in it. For me, Microsoft, I think, just looks a lot like the other software names personally, but I get the argument, and I think that again, an area like that has been so underperforming for so long, at some point does it start to get brought up with everything else? It's not happening yet, and I think that's the most important signal here today. Folks, that'll do it for today. Thanks so much for joining me here on the show. Apologies for not being at 100% voice-wise, but I appreciate you hanging in with me. I'm going to go rest up and drink more herbal tea and vitamin C and get through all of this, but I appreciate you guys joining me. Thanks so much for the great questions. I see a couple we didn't get to. We will put those in the mailbag. Planning an all mailbag episode, so no live show tomorrow. We'll be going through some of the great questions. It's not too late, so if you have a question that comes to mind, please pop it into the comments section on our YouTube channel. For now, I would say thank you so much. Have a great evening. And remember, it's always a good time to own good charts. Take care, folks.